Let's be honest, nobody's running at 100% occupancy all year round. And if you are, you seriously need to look at your ADRs. No one should be running that high.
One of the things that scares me the most is a lack of clarity around payroll, right? Because that's your single biggest cost.
Expense.
We operate trust accounts, right? So at the end of the day, you can't hide anything. Everything is going to be verified.
It's important that when you sign a contract, ideally you've got an upfront understanding as to how the methodology of how you're going to calculate the value of a key, either won or lost, right? Before, from the time of signing a contract to settlement.
The clawback and clawforward is a protection mechanism
Absolutely.
based on the financial operation of a business. Winston, why is that important coming in from a purchaser's perspective, an owner perspective?
If you lose a key, you may.
Welcome to RB Radio. I'm Frank.
And I'm Trudy. Join us as we explore the very exciting world of the accommodation industry.
We're going to walk you through the ever-evolving landscape of hotels, motels, caravan parks and management rights, but more importantly, the communities and the stories that underpin them all.
From market trends and expert predictions to the personal success stories and many lessons learned, we're going to cover it all.
Join us and let's embark on this journey through the weird and wonderful world of the accommodation industry together. Ladies and gentlemen, welcome back to RB Radio, Resort Brokers podcast for the accommodation industry. My name is Frank Matus, and we've got a very special episode today. It's a kind of a podcast first. I'm going to be joined by my second-time guest, first-time co-host, Chenoa Daniel, who is our senior broker from the Sunshine Coast. Chenoa, welcome to the hosting table.
Thank you. I am so excited to be back. I'm surprised you asked me back again, but hey.
Exactly. Well, we had to get you back because we've also brought back our most recent guest, because our last episode we didn't quite get into the detail of what we wanted to talk about. We got the introduction done, but Winston Hall, Managing Director of Seabreeze Resorts, welcome back to RB Radio. You're basically part of the furniture now.
Oh, it feels like it, absolutely. And great to be back again, Frank. And Chenoa, thank you for co-hosting today. I look forward to lots of great questions.
Absolutely.
Well, what we wanted to do this time is I want to let you guys really dive deep into the deals that you guys have done, because you've got 6 properties now, Winston, and really moved from that corporate side of the industry into the management rights side, but corporatizing that again, and utilising your experience from that big business side of it within the hospitality industry. And Chenoa's been a part of many of those deals that you guys have done. So let's get right into the how these deals operate, how you, not so much the operation of your business, but operation of growing your business potentially. I think that's probably where we can start. Chenoa, do you want to lead us through?
Yeah, the art of the deal.
The art of the deal,
and
in fact, yes.
It's a ride. It really, really is. And I think the beautiful thing is, Winston, we've done 4 transactions together now, hopefully more together in our future. But I think the thing is we both quite intimately know how we work together now, and it's obviously we've moved to a position now where I know what you're after and I can bring you opportunities and share those opportunities with you. But we've also had some very interesting conversations along the way. Dare I bring up the claw, the beautiful clawback, clawforward, which is always one that we enjoy.
So just to jump in,
conversation.
Chenoa, explain to us what a clawback and clawforward is for the people that are listening that don't quite understand that intricacy of a management rights deal.
The claw, absolutely. So a clawback was generally something that we always had in permanent resorts. So when you're purchasing a management rights, you've got your caretaking and letting agreements, you get your remuneration from your body corporate work. So if you put that aside at a P&L, the rest of the money is derived from your letting income. So what we would generally do from a methodology perspective is we would divide the profit from your letting pool divided by the amount of keys that you have. Simple methodology. Tells us what each key's worth, and then it's popped onto a multiplier. The intricacies with the short stay is obviously substantially more, and that's when generally, as much as I think I'm an accountant, I like to have my say about people's P&Ls. I'm not an accountant. I am clearly a broker agnostic in my lane. But the important thing is, and particularly somewhere where I work and where Winston is obviously heavily invested on the Sunshine Coast, is that per key amounts are substantial.
They can vary as well.
We transacted one a couple of years ago and it was $400,000 a key on the multiplier. That's not chump change for a lot of people. The keys that, we've worked with have ranged between $50,000 to a key to $100,000 a key on the higher spectrum. So having those negotiations up front has just been so important. But it's so pivotal. It's so pivotal because you're working on a letting pool that's, say, 23 keys, and you're earning $998,000 out of those 23 keys. And majority of it is coming from the letting component. So we have to have those conversations. Deals are taking longer than they've ever taken before. Most transactions are what should be 3 months, turns into 4, turns into 5, depending on the body corporate.
So the clawback and clawforward is a protection mechanism
Absolutely.
based on the operations, the financial operation of a business. Winston, why is that important coming in from not an operation perspective, but a purchaser's perspective, an owner perspective?
100%. I guess, look, if you're buying an asset and there's 25 keys in the letting pool, and the profit that's been derived off that over the last 12 months has been, call it $1 million if you want to.
Keep it round figures for
That's right.
the ones that have to add this up on a piece of paper.
That's correct. That's correct. And, for me as well, obviously. The profits derived from that, if in the process from signing a contract to settling the sale or settling the property in the transaction, you end up the vendor loses a key. Right, that could have a material impact on your future profit. So it's
your ability to make money.
Correct.
Yeah.
So any bank is financing you into buying this deal. Obviously, the historical profit is very relevant to what that debt to equity ratio is going to be required to obviously purchase the transaction, and the associated value that's required by the bank to obviously ascertain is that the right value that's attributed to that particular business and transaction. If you lose a key in the process, right, it can have a material impact on your value, and therefore it may end up affecting the equity that you require to actually fund a deal in the first place, right?
Yes.
So it's super important that you have some kind of protection in place that actually prevents or considers how you would handle that situation in the event that a vendor loses a key or 2 keys for that matter.
Absolutely, and there's a mechanism in place. That mechanism is overarchingly about the transparency of how a management rights deal takes place from beginning to end. And like you say, Chenoa, these things can take 4, 5, 6 months these days. Yeah. But the purposes of that time and the reason why it's taking longer is for the buyer and seller to be protected on both fronts.
Absolutely.
And the clawback is just one of the things that we do along the way. And a lot of that's decided in that first stage. Like once you sign a contract, that clawback is done in that conversation, isn't it, Chenoa? It's important to do it up front.
Look, you could ask every broker and they're going to have a different opinion, but whenever I'm facilitating a transaction for my client, I think it's best to get everybody's intentions and understand where both parties sit from the onset. That way, it just makes the deal more harmonious during the whole transaction. If we need to have a difficult conversation, let's do it now, and then it should maybe make the rest of the deal a little bit more smooth. You're always going to have to be fluid. You're always going to have to pivot during a transaction, depending on what crops up, particularly the more intricate deals, which I always seem to end up with, and I love that. I'm that.
Well, you're in an intricate space. You're on the Sunshine Coast, and these things can be complicated up there because it's not one style of asset.
No, and it's also different in the country with the price of real estate. And I'd love to have the conversation about return on investment versus multiplier, because this is something that we need to come back to. It really gets me. But, definitely with the clawback, clawforward, it is something that I think is pivotal to have those conversations. And it's not always this is one size fits all. And it's not always going to come back to the accountant says it's this. Like you and I recently did a transaction, and we had to have the conversation about what that clawback figure would look like. There was some argy-bargy from both sides, and we ended up agreeing on a number, and that number was agreed by both parties, and we actually ended up having to use that clawback, clawforward during that transaction. And tell me, how did you find doing a process and doing these clawback, clawforwards how did you find actually dealing with those clawback, clawforwards during the transaction?
Well, firstly, that was my first introduction. That deal was the first introduction to the claw, if you want to call it that.
The claw.
That's cool. I think there's a separate podcast
About
called
the
The Claw.
claw, yes.
maybe.
I agree, and Mike Phipps mentioned about the clawback. We should really seriously consider this for this particular deal. And I went, what the hell are you talking about? Like, I honestly did not know what this was initially, and he gave me obviously a very quick education around what it meant and the reasons why, right? Which is we've touched on that. In terms of that, it's important ideally that when you sign a contract, you've got that part negotiated. It doesn't have to be in every single deal, but ideally you've got an upfront understanding as to how the methodology of how you're going to calculate the value of a key, either won or lost, right? Before, from the time of signing a contract to settlement. And because if you don't, then you end up with a situation where you could end up in conflict or dispute.
Yeah.
And you want to mitigate that throughout a deal. I mean, Chenoa wants to mitigate that. So
being clear is being kind, and that
100%.
contractually
Absolutely.
it's important, because then there's, these deals are taking longer because there's protection mechanisms, but that is mitigated by the fact that if it's written down up front, it means that there's no surprises, that people don't feel like they're being blindsided
100%.
as they progress through to settlement, which could be 6 months down the track.
Correct. But you bring up a really interesting point. It's not on all of the transactions that we've done together. No. It's only on the ones with the big net profits and the small keys. So
typically speaking.
Absolutely. Yeah. But let's be honest, nobody's running at 100% occupancy all year round. And if you are, you seriously need to look at your ADRs. No one should be running that high.
Just for the people that are listening at home, ADRs in the context of management rights?
Your average daily rate.
Okay.
So
not everyone's a hotel operator, and we need to
You are correct.
Good, yeah, absolutely.
Here I am just rambling on.
Rambling with the
all
acronyms RSVP, ASAP, Chenoa.
Oh my goodness. Yeah. So nobody's going to run 100%, are they? There's obviously going to be times that you're going to be sitting at that 100%, but generally you lose a key, you gain a key, it doesn't affect it too much. So this is really a conversation for that really high level assets, like what you guys are buying. You've got luxury assets, so you probably see it more than others. But you mentioned something in our last episode that I found really interesting, and you mentioned about doing the deep dive into wages. And again, this is something I'm super passionate about, and I work a lot with accountants in my space when I'm getting a P&L ready for sale, is having that transparency of wages. And I think this is so important for you as a buyer and for us to educate our sellers about and to continue the conversations with accountants. We operate trust accounts, right? So at the end of the day, you can't hide anything. Everything is going to be verified. That's why we're able to sell in a 12-month period, and majority of other businesses are not. So at the end of the day, if there's something there, you're going to see it anyway. So my point is, as a broker, let's just give the buyer everything, and that way you can make an informed decision. I know you have a special little sheet that you plug in, your little ROE sheet that one day you will share it with me. But if we give you that information up front and we're open and honest and transparent with that, does that mean that you would be more inclined to give us a higher offering price or a better multiplier, tighter return on investment with that knowledge in hand?
Super valid point, right? So, as a buyer, one of the things that scares you more than anything else is really a lack of understanding or uncertainty around the business and its ability to perform and actually deliver a profit, right? So if you do not have clear information in terms of the due diligence, early due diligence phase, and I'm not talking about formal due diligence, in the investigative period where you're actually looking at a deal and going...
This is before you signed a contract.
Before you sign a contract, you're looking at all the data, and the P&L is obviously one of the most critical pieces. And if you... I've seen, I look back yesterday actually, and I reckon I've looked at 50 properties in the last 2.5 years, like seriously had a good look at them.
Yeah.
And we've obviously got 6 properties that we've executed. So it gives you an indication on the volume of work that we've looked at, but also, just the nuances, the things that I've seen from different, I guess, businesses and suppliers to those businesses or partners, and the information that comes through. And one of the things that scares me the most is a lack of clarity around payroll, right? Because that's your single biggest cost.
Expense,
right?
Absolutely. And especially where it has to be looked at in management rights, it has its own very unique way of seeing it through the eyes of a 2-person management team.
Yep.
And even though the management rights industry is very robust in talking about the way we view industry based expenses, that wages thing, that's different for the subjective view of that can be different for every operator.
Yeah.
Absolutely.
Yeah.
And you know, so having an accountant follows an industry standard practice as to how you actually detail a P&L for sale is super important for a buyer. Again, I've seen some people, no disrespect to any accounting firm that may have prepared a P&L for sale for a business in the past, but may not either choose or understand that particular formula. They, you know, when I read a P&L and it is not clear and it does not really clearly articulate what has been removed from that P&L and the reasons why, then, you know, I've got an immediate suspicion around, is this an accurate P&L? And what am I, and so what am I going to discover if we do proceed with buying it?
And how does that affect the saleability of that asset, let alone your purchasability?
That's correct. So there's, you know, it comes down to that level of confidence around, have I got a business here that's clean? The numbers are clean. I've got real transparency around how it's been operated, and therefore is it something that I'm interested in? And if I can't get those answers really quickly, I move on.
Yeah.
And Chenoa's point is trust accounts. They're audited every year.
Every year.
So everything's on the table. You've obviously come to a good brokerage firm to be able to sell your asset. There's no point in trying to hide anything, and the
There's
only
no
way you're
point.
going to get good operators involved, like yourself, is by being as transparent. And that's not running a perfect business. That doesn't mean that, does it, Winston?
No.
Because there's no such thing.
No, there is no such thing.
Yeah.
I mean, I don't run a perfect business.
But that
you know.
also, from somebody that's operating 6 businesses, I'd say you'd see that as opportunity occasionally where, okay, well, no, this is where things we can put our special sauce in and grow this business because things haven't been as efficient or whatever the case may be. Because it's not about perfect, it's about transparency.
Yeah.
Yes.
Yeah.
100%. Because if you've got, as a buyer, you've got a high level of confidence that the information that's received is accurate or pretty accurate, then you've got a higher chance of actually executing and settling on a deal. So I think from, you know, Chenoa's point, it's absolutely spot on in terms of what's really important is the information is upfront, transparent, and, you know, if there is an appetite as a buyer to buy that product in that location at that time, then you'll go for it.
Yeah.
Yeah, absolutely.
So I really think the takeaway for this, for a buyer and a seller, is pay attention to the P&L, because at the end of the day, if, like you said, if you don't have the confidence from that P&L and it's not transparent, you're just going to move it to the side and move on to one that is. So if you really want to maximize your business sale, you're going to pay the money and you're going to get a decent P&L. Like, it's a comment I hear all the time, oh, it's expensive to get my figures done. Well, it's going to cost you more.
In the end, and at the very least in time or renegotiation, or
you're going to lose a great buyer.
Use the great buyer. You said something a minute ago, Winston, which you looked at 50 businesses. I reckon I would argue that you've looked at more, would be just my guess in how I understand this business, and that you've purchased 6. So that's a less than 10% hit rate, right? If my math is correct, it might not be. But it goes to show that, it might be a little bit more than that, but I would say that you've probably looked at more because you've probably dismissed some out of hand a lot quicker. Yeah. You've probably looked at 50 seriously, right? So that gives you an idea of buyers are looking for specificity in what their next step in this game is.
And even further, buyers are educated now.
And becoming more so.
Absolutely. You know, by the time they get to me, they've talked to Paul, they've talked to Trent, they've talked to
lawyers,
their neighbour, they've talked
accountants,
to their
finance brokers,
friend's dog next door. They've talked to everybody. So the thing is, gone are the days of people would go, oh, I like it, it's shiny, it's pretty, I'll pay that multiplier. It doesn't happen anymore, and if it does, it's very, very rare. Like we talked about in the last episode, buyers becoming more sophisticated. It's really, really moved from emotional lifestyle purchases to this is a business transaction. And by doing so, us as an industry need to move with that as well. Then you're right, you know, your accountant's going to go in and they're going to look at an historical 12-month period, and that's what they're going to verify on. But if you take it to the next level, a bank valuer is going to come in, they're going to look at that P&L and they're going to look at the history and they're going to go, that's fantastic. But from a sustainability point of view, where are we going from here? Because that's what the bank's lending you on. They're not lending you on a history and how well the previous manager did. They're going, is this sustainable? Are we going to give you that money to buy this business? So that's why it is just so important to make sure that, if you're looking at a business, you're looking at a business and you're looking at a proper P&L. So if you're looking at going to market, get a decent P&L or just don't get one at all.
You bring up a good point from the P&L because, Winston, the bank's a majority partner in this, essentially.
Yep, correct.
And so that relationship with the bank is that they're going to be money in and money out at the same time if things aren't going well. So talk a little bit about how you manage that with, I know you don't want to give away the secret sauce that you've got in regards to your return on equity or your return on investment conversations, because that's how you run your business. But talk about that, how that influences the relationship that you have with the bank, because the LVRs, the loan to value ratios, are very strong into management rights, and so you have to manage that relationship well.
Yeah, that's right. Now, look. I mean, I guess first and foremost, have a great finance broker who's representing you to the banks and finding the best possible deal. And I know you spoke to Paul Grant from Might Fix Finance around that, and ultimately that's a good stepping point. But meeting with your bank manager or senior executives of the bank is very important at some stage in the journey, right? Because it's like anything. It's a relationship first and foremost. Yes, it's a commercial and business relationship, but they need to understand who you are as an operator, where you're going, what you're about, what your experience is. That's all very relevant to them to ascertain risk, right? And so what is their risk appetite to lend you at an LVR of 70% or 65%, So, that's pretty common. Sometimes it's less, depending on the operator. Sometimes
it depends on a variety of factors.
And
you can't just bank on that.
That's right. And so, that relationship with your bank is, again, really important. So they understand your level of expertise and intent and your plan to actually, grow the business and for them to then lend you that money and make sure that they're not taking a big risk. That relationship piece is really important. So, as well as your plan.
Interestingly, on a valuation that's given to the bank, quite often I'll get the valuer ring me and go, hey, Chenoa, tell me a little bit about the buyers. And when you read them, they actually have a section where they do talk about the buyers to the bank, so, and that's another thing, having a good business plan. You can't just walk into these businesses, particularly on your level, and not have the foresight to understand what your business is going to grow into, what it's going to look like, and being able to portray that to the bank and have those conversations so that they have the trust in you. You're right, usual lending is going to be 65%. Someone like you might get higher than that just because you're a proven performer. We've seen it. We've seen high LVR ratios. So, you are right. It does matter having those relationships.
Yeah.
Absolutely.
When we were progressing through the cycle of getting us to the settlement, which
Legal
could be
DD.
three down. Next up, legal due diligence.
I love legal DD.
You mentioned something earlier, Winston, where you'll want to be prepared as much as possible before you start spending money with solicitors preparing contracts and whatnot. What are some of the things that you look at where you don't have the information versus some of the information that you then really delve into when you're going through due diligence using a specialist like Trent Peavy for your deal?
Look, I think, the access to information in the early stage, I call it early DD, so the informal DD, so the stuff you do as a buyer to ascertain is this a good deal or not, And
you might get access to AGM minutes and
Correct,
some committee
correct.
meetings
That's
and stuff
exactly
like
right.
that. Is that kind of what you're talking about?
So the things that I'm interested in, obviously outside of the P&L that's being prepared for sale, is the AGM minutes, is also the sinking fund balance, any material issues that have come up in terms of the building that may lead to a special levy. These are the things you need to sort of look out for because, as buildings in Queensland, they're getting older, right? They've been around, some buildings have been around 40 years. We've got our first fund, Seaview, is 42 years old. So you really need to...
42 years young.
Yes, that's correct. Super. So you need to look at what is the health of their sinking fund so you don't get...
And this is information that you can get up front. So this is before you spend any money. And unfortunately, we're in a situation where everyone is experiencing cost growth in all industries, not just management rights. So you're doing this stuff. These are the things with a good broker that you get up front for free. So this helps you ascertain before you start spending those big dollars.
And we talked about payroll earlier, and so understanding how that business works. So you can do this in the early phase and go, hey, Chenoa, I'd love to know what their rosters are on the front desk. I don't need to know who specifically.
Caretaking and letting agreements.
Caretaking
How
and
much
letting
can you
agreements.
find out
What's the
about
scope
that?
of duties? What's the requirements? In that regard, how many hours have been allocated to the caretaking duties? Is that an appropriate amount based on the duties that's accrued in the P&L? Because look, let's be honest. Some are new caretaking agreements, and they've got very detailed scope of duties, and you can ascertain a good number of hours per week and per month, and some are very vague.
Yeah,
and
everything in between.
That's correct. And so, really digging into that as much as you can to understand the business. I mean, the other part that I also like, and it depends on the vendor as to how you can get this, but is also you get high level information from the P&L for P&L for sale, occupancy, average daily rate, that sort of thing. But the thing that I like to drill into early in the piece is the market segmentation. Where is your business coming from?
Yes.
Right?
Oh, interesting. And this is quite specific to short-term management rights.
Correct.
Yeah.
That's right. And the more I can understand that, then I can ascertain what I think the opportunity is. Can I grow average daily rate? Can I grow occupancy? And with your knowledge of that particular destination, what markets can I target to try and drive occupancy and revenue and therefore enhance my performance? So as much as I can get that information up front, then I'm more informed and more confident about making a decision to buy it.
So that's up front. Flip that into the due diligence process where you're paying your solicitors to get into the down and dirty, the body corporate role searches, etc. What are you looking for there? When you say, Trent, I need you to delve deep into this, what are the things with your experience that are the hallmarks of what you're really looking for?
Look, I guess, Trent and the legal team will obviously dig into making sure that any historical assignment has been done accurately, so therefore, and appropriately, therefore there's not going to be any hiccups.
And by assignment, you mean every time the business is transacted?
Correct. Correct. Yeah, that's correct. And making sure, because I have encountered before that basically an assignment process was not done appropriately and could create a risk for the business in terms of it could be challenged by an owner, and that was identified in a DD scenario. So
this is the I's dotted and T's crossed element.
Absolutely.
Yeah.
So in that process, you're looking at ascertaining risk, and there's always risk in buying any business, and you will get identified in a legal DD process. Always something that's going to identify a potential risk. You need to quantify how big that risk is and then how you manage it. Another instance is we had a Gallery V clause that was not written correctly within a caretaking agreement. And
Gallery V is a whole new podcast, really.
Yeah.
Oh boy.
I'm going to leave that one with you to explain that later. But
That's okay.
Thanks, Winston.
but that Gallery V clause, the bank required that to be amended within the first 12 months of operation. Now, we took that on as a accepted risk, because you've got to get owners and the committee to support that change to the caretaking agreement. But we felt it was a small enough risk. But they're the things you got to look out for, and what a good lawyer will actually pick up to protect you and mitigate your risk into the future.
As an operator, ascertaining that commercial risk from the input from your associates, your lawyer and your accountant, it's not about finding the perfect business like we've talked about before. There's no such thing. Everything is going to have its individual components that are upside and downside along the way. But managing that commercial risk for what's right for your business, that takes a little bit of nuance.
Yeah, absolutely. And, it's I think you as a buyer, you have a risk appetite.
Yeah.
Like, it's just a matter of where are you at, what's your level
Because risk
is.
equals opportunity sometimes
That's
as well.
right, exactly. And you never 100% know a business. As much as you dig in and do an early DD and you do a formal DD process, you do never do you know exactly that business until you get into it, right?
Yeah.
And so there's always an element of risk associated with that.
And you're going to run it differently a little bit to the person that was
That's
running it
right.
before, and that's where the rub is.
That's exactly right. That's the as you say, the secret sauce to some degree.
Yeah.
And you know that's the opportunity you look for in any business that you're looking to buy. But understand there's always an element of risk. You just got to quantify it, and that's what the legal process does.
Look, we're running out of time once again. However, so as we're moving through this process, the next big one,
We didn't even get to return on investment.
we
versus
haven't got to
multiplier
return. That
yet.
could be a whole different
How?
thing. But what we'll get to before we finish up
Yes.
is this last stage. So we've sort of round out what would happen with the finance side, and that's a very personalised thing with
Absolutely.
LVRs and equity and that kind of thing. So we can skip over finance because we've covered it a little bit, and then we've got the juicy one, right?
The
Assignment and body and the engagement with the body corporate. This could be a whole podcast on how an experienced and an operator will value and invest in the relationship with the body corporate. Talk us about how you do that to round us out for today's episode.
Yeah, look, no, it's a really good point, and it's a super important point in management rights. Fundamentally, is how you engage with the committee, who obviously will assign your management rights or not. But majority of the time they do, because there is obviously, they need to be fair and reasonable in the way that they act. Ultimately, I believe that, you know, this in itself is a big topic, because
Yes.
you know, your approach to owners and any building that is in management rights is really important. And values of transparency, integrity, honesty, those sort of things, and how you communicate with owners and a committee is super important, right? And
Yeah,
that's
100%.
what, if I'm an owner and an investor in a management rights, and I'm looking at a potential new caretaker and management rights owner, I want to know that they're actually a good person. They've got a good business model. They're actually got, you know, values that are important to me as an owner of that property, regardless of whether I'm letting with them or I live in it, or whether I actually, you know, use an Airbnb. These are the things that you need to understand. Having a plan that you can articulate in terms of who you are, what you're about, why you want to buy that business is super important, and be confident around those key values, because, you know, you got to think about what is an owner looking for, what is a committee looking for. If you can do that really successfully, the assignment process is quite smooth.
Let me ask you a specific question, and feel free to dodge it as easily as you can.
Sure.
But you've bought 6 businesses. You didn't buy them all at once.
No.
When you were talking from one body corporate to the next, did you disclose your business beforehand to that body corporate? Because I think everyone's favourite radio station is WIFM. What's in it for me? And so there's a
100%.
very real engagement piece about one body corporate to the next. Am I going to lose Winston as my direct contact?
Yeah.
Am I going to, is that now going to be divided by 5 instead of 6?
6, yes.
So how do you manage that process with a body corporate, just to round us out on this very small subject?
So I guess historically for us, it's dependent on the business. So in the case of Rise, where I was the main point of contact, I was going to operate the operations of that resort day to day. I'm the main point of contact, and that was what was in our business plan at the end of the day that we presented to them and talked about that. The other properties, I've had managers who are going to be the main point of contact for the committee. I'm obviously the managing director of Seabreeze Resorts, so I am presenting Seabreeze Resorts as the company that's acquiring the management rights. This is my role, and here's the building manager and resort manager that will be operating the day-to-day, and there'll be a main point of contact for regular operations and caretaking and so forth. And that's how I presented it. But in terms of disclosing other properties, the initial business plans I did, no, we did not. But as we've grown, absolutely.
Because you made it a value proposition for the next business.
You're 100% on the money. Exactly right. We're a group. We've got scale. We've got great sales and marketing is part of our pitch in the business plan, because we partner with a company called Pinnacle Marketing based up in lovely old Cairns. They're wonderful operators and represent us really well. And I talk about our sales and marketing as a leverage piece, because not every individual has that capability.
Correct.
I mean, other corporates do, but a smaller operator doesn't have that same level of support.
An overarching theme here to finish us up seems to be transparency at every step.
At
and
every
that
step.
that becomes the benchmark of a good operator, which you're demonstrating perfectly. Winston Hall, thank you very much for sharing us. We've had a part 1 and part 2 of our podcast this time, but I think there's some real value in the people that are listening. Chenoa, finish us up. What can people contact you directly? Because I think you're one of our better brokers on the Sunshine Coast, definitely one of our only ones.
Thank you.
So how do people contact you to speak directly about potential opportunities and try and, take some of Winston's market share here?
Oh, well, I don't know how Winston's going to feel about that now. Jeez. Look, absolutely. My phone number is everywhere online. Google me. I'm going to come up. Our social media, head over to Resort Brokers. You'll find our links on there. Otherwise, give me an email, give me a call. I would be happy to get some people in competition with the lovely Winston over here.
Winston, thank you very much for joining us on the two-part series, really delving deep into that management rights and the corporatising of the management rights industry. We really respect and value your time. Thank you for joining us on Resort Brokers Radio.
Look, absolute pleasure. I mean, I love this industry. I could talk about it all day long, so it's been an absolute pleasure. Thank you
Absolutely.
very much.
We'll get you back for sure.
Thank you.
Thank you very much. Thanks for joining us on RB Radio. Thank you for joining us at RB Radio.
If you enjoyed the insights from this episode, we'd love your support with a 5-star review on Apple Podcasts and Spotify.
Stay connected with us on all social media platforms at Resort Brokers. We're excited to continue this journey with you and see you in the next episode.
See you then.